now wondering how to keep more of your hard-earned retirement savings from getting eaten up by taxes, you're not alone. Have you ever considered your retirement accounts and thought, how much of this will be mine after taxes? The truth is, without a strategy, taxes can take a bigger bite than expected. But don't worry, we've got you covered. So tune into this episode of My Hybrid Retirement Weekly, where we're going to tax-saving strategies that can help you keep more of what you've worked so hard to build.
You're watching My Hybrid Retirement Weekly, the show that helps professionals work less, earn smarter, and embrace more financial freedom. Hosted by Leiphart, a fiduciary advisor. New episodes drop every Tuesday at 12 p.m. Eastern. Subscribe now and start planning retirement on your own terms.
Leiphart here, helping you achieve work-life balance and long-term financial independence. This week on My Hybrid Retirement Weekly, we're uncovering powerful tax-saving strategies to help you maximize your retirement income. Because the less you give the IRS, the more freedom you have to enjoy your next chapter. Before we dive in, be sure to subscribe so you never miss an episode filled with practical strategies to retire on your terms. Quick question. What would you do with the extra money you don't have to pay in taxes? Travel more? Spend time with family? Or invest in new experiences? If you're on LinkedIn or Facebook, please drop your thoughts in the chat. Here's a quick look at what we did this week. Here's the deal. Taxes don't stop when you retire. In fact, without the right planning, you could end up paying more than necessary, shrinking the income you get to enjoy. And with tax rates uncertain in the future, it's more important than ever to be proactive.
You're make $47,151. Your marginal tax rate was 22% in 2024. But if you make the same amount of money in 2025, your marginal tax rate will be 12%. So let me explain how the new tax brackets will affect you. The first thing we need to understand is that we use a bracket system. And a marginal tax rate is the rate paid on the last dollar of taxable income. This will come in handy in just a second. So in 2024, only the $47,151 will be taxed at that 22%. All the dollars between this range will be taxed at that 12%. And all the dollars up to $11,600 will be taxed at 10%. Now, the federal government may adjust tax brackets to keep up with inflation. So here are the new tax brackets for 2025. As you can see, someone earning $47,151 in 2025 will now be in the 12% marginal tax bracket. But realistically, you won't see a noticeable change in your taxes. That's because only one of your dollars was being taxed at that higher percentage of 22%. The majority of your dollars were still being taxed at that 12%. Now, we encourage everyone to do proper tax planning because it can save you a lot of money. And if you want to learn more about how your taxes will change in 2025, be sure to check out this article.
Without a strategy in place, here's what can happen. Higher required minimum distributions, or RMDs, force you to withdraw more than you need. Increased Medicare premiums, cutting into your retirement income. Unnecessary taxes on Social Security, reducing your benefits. That means less money for the things that truly matter: family, travel, or your time and freedom. But with the right approach, you can legally minimize taxes and keep more of what you've worked so hard to build.
$400 grand last year just to live in LA on state tax.
I heard there's a way around it.
Tell me.
I learned about this after I already left California, but to my understanding, there is a way to run it through the business. You pay it through the business, and that way it's deductible on that level before you take a salary.
I'm gonna have to look this up.
I think it's a gray area as far as I'm concerned.
I don't know if I should probably do it then.
Unfortunately, the more I get into taxes, the more I realize that the whole tax system is a gray area.
Very gray.
It is insane. And everything is open to interpretation. And it's like, how well could you argue your case? It's like whoever has more money could learn these gray areas and hire the right people to do it correctly in such a way that's compliant. It's insane.
So how do you take control of your retirement taxes? Here are a few key strategies that can make a big impact. Roth conversions. One of the most effective ways to control your future tax bill is through strategic Roth conversions. This means moving money from tax-deferred accounts like a 401k or traditional IRA into a Roth IRA. You pay the taxes now while rates are at a historical low, so your money can grow tax-free for the rest of your life, and then you can withdraw it tax-free as well.
Ideally, one of the best times to do a Roth conversion is when the stock market is down. When the market is down, the value of your traditional IRA is lower. So that means if you convert at this time, you're going to be paying taxes on a current or reduced value. If you find yourself presently in lower income years and you anticipate your income to be higher in the future, this can be a great time to do a Roth conversion. By converting during lower income years, you avoid pushing yourself into a higher tax bracket. And it's a really good idea to spread the conversion out over several years. Right now, the stock market is at all-time highs, but we're still seeing a record number of Roth conversions. So that brings us to some of the other drivers. You can help to eliminate or at least reduce future required minimum distributions. Other strong argument to make a conversion comes from an estate planning perspective. When we talk about passing on retirement accounts to heirs, if they inherit a Roth account, any withdrawals they make come out completely tax-free.
Tax-efficient withdrawal strategies. Order matters when withdrawing retirement income. Instead of pulling from tax-deferred accounts first, consider a blend of sources, taxable, tax-free, and tax-deferred, to keep your taxable income lower and avoid unnecessary tax.
Tax-efficient withdrawals are a crucial element in American retirement planning. They involve a strategic sequence to minimize tax liabilities and extend retirement savings. The concept starts with withdrawing from tax-deferred accounts like 401ks first, followed by Roth IRAs for tax-free withdrawals. Alternatively, individuals can adopt a proportional strategy, balancing withdrawals from various accounts. This approach leverages tax brackets efficiently, potentially allowing for better investment growth opportunities. Consulting a financial advisor on optimal withdrawal strategies ensures a fulfilling and financially secure retirement, making complex concepts accessible to retirees.
Third, qualified charitable distributions, or QCDs. For those 70 and a half and older, QCDs allow you to donate directly from your IRA to a charity, satisfying your RMDs, or required minimum distributions, while reducing taxable income. If giving back is part of your plan, this is a win-win strategy.
What's great about a QCD is that the contribution is not included in your taxable income, and therefore an itemized deduction is not necessary. This is very important because you do not have to itemize the contribution to receive an immediate tax benefit. You receive the tax benefit from your contribution whether or not your itemized deductions exceed the standard deduction.
Fourth, avoiding the Social Security and Medicare tax trap. Did you know that the way you structure your withdrawals can have an impact on how much your Social Security gets taxed and whether you pay higher Medicare premiums? Thoughtful planning can help you avoid these unnecessary costs.
In order to know how much of our Social Security income is subject to taxes, we have to start with our provisional income, PI, provisional income. Now, the formula to determine that starts with this. We have to go to our adjusted gross income, then we add back in any tax-exempt interest that's on your return, plus 50% of what your Social Security benefits are. So we add those three together, and that gives us provisional income. Then we go to this chart, which shows the thresholds that shows how much we have to pay in taxes. So if my provisional income as a single person is $25,000 or less, zero of my Social Security is taxable. If it's $34,000 or more, 85% will be taxable. If it's in between here, 50% is taxable between 25 and 34. Now, if I'm married, the thresholds are $32,000 or less, zero is taxable. $44,000 or more, now 85% would be taxable. Anything in between is going to be 50%.
Maximizing tax deductions. Don't overlook key deductions like medical expenses, long-term care insurance, and home office deductions. Yes, even in retirement. These can help offset taxable income and reduce your overall tax burden. Now you might be wondering, how do I put these strategies into action? That's where having a personalized plan comes in.
So it's you're saving on taxes by contributing initially, and then you're actually not taxed on any of the growth until you withdraw that during your retirement years. Right?
Exactly. You're not taxed on the growth when you withdraw it. That's the biggest thing. You're only taxed, it just becomes a part of your retirement income. So it's basically deferring income from when you're younger, when you contribute.
The truth is that tax laws are always changing. Right now, we're in a historically low tax environment, but that won't last forever. Taking action now with strategies like Roth conversions and tax-efficient withdrawals can make a massive difference in your long-term financial planning and long-term financial security. And here's the thing, every retiree's situation is unique. There's no one-size-fits-all solution. That's why working with a fiduciary advisor, someone who's legally required to put your best interest first, can help ensure you're making tax-smart decisions without the guesswork. I know taxes in retirement can feel overwhelming, but a little planning goes a long way. Let's tackle some of the biggest questions I hear all the time. First, why should I worry about taxes in retirement if I'll be in a lower tax bracket? This is a big one, and I hear it all the time. A lot of retirees assume their tax bill will be lower. But here's the reality. Required minimum distributions, Social Security taxes, and even Medicare premiums can push you into a higher tax bracket than what you expect. Plus, tax laws change, and today's low tax bracket might not be so low in the future. That's why having a strategy can help you avoid surprises later. And I'll use a current client as an example. I have a client that has a pension, Social Security, and a very large IRA. When they start taking the required minimum distributions, they have no control over what those distributions will be. Those distributions, coupled with Social Security, coupled with the pension, which again, they have no control over what those amounts are, put them into a tax bracket that's higher than in their working years. So working now to convert some of those dollars to Roth helps mitigate those taxes in the future. Another common question I hear, are Roth conversions really worth it, even if I have to pay taxes now? For many people, yes. Paying taxes up front with a Roth conversion can mean decades of tax-free growth, no required minimum distributions, and withdrawals that won't increase your taxable income. It's not for everyone, but if you believe your tax rates will rise in the future, locking in today's lower rates could be a smart move. Another common question I hear is, what's the biggest mistake retirees make when it comes to taxes? And it's not having a withdrawal strategy. Many retirees start pulling from their tax-deferred accounts first, which can trigger unnecessary taxes and higher Medicare premiums. A better approach is to use a mix of taxable, tax-free, and tax-deferred withdrawals to keep your tax bill lower and stretch your retirement savings further. Got more questions? Drop them into the comments if you're on Facebook or LinkedIn, and I'll cover some of the most pressing concerns in a future episode. Let's quickly recap your tax savings retirement blueprint. Roth conversions help protect you from future tax hikes. A tax-efficient withdrawal strategy keeps you in a lower bracket. QCDs reduce your taxable income while supporting causes you care about. Smart Social Security and Medicare planning can save you thousands. Deductions help offset taxable income. Imagine heading into retirement with a clearer tax plan, knowing more of your money stays with you. Less stress, more freedom, and the ability to focus on what truly matters, whether that's family, travel, or your next big adventure.
If you want to lower your tax payable, you need to load up on expenses that are tax deductible. Now, the important bit is this. Those expenses better be able to increase your income. So expenses that are associated with building your skill sets to increase your income. That's one. The second one is expenses that are associated to build the value of your net asset position. If you can load up on those two tax deductible items, therefore, it makes sense to save on those taxes and increase your wealth and income potential.
Now it's your turn. Subscribe to My Hybrid Retirement Weekly for more strategies on building financial independence. Ready to build a tax saving strategy? Let's chat. Schedule a discovery call today. Thanks for joining me today. Remember, tax planning isn't just about saving money. It's about creating freedom and security in retirement. Until next time, keep making smart financial decisions, and I'll see you soon. Let's chat.